working capital components learning quiz. So we've got a half dozen or so questions to test your understanding of the concepts covered in this lesson. Let's start off with the first one. Identify 3 common business transactions that give rise to items in working capital on each side of the balance sheet and the names of the items and whether they are an asset or a liability. So first is sale on credit terms, and the items concerned, the accounts are on the asset side, accounts receivable, and on the liability side, accounts payable. Next one, paying for goods or services in advance. On the customer side, this results in an asset, prepaid expenses, and on the supplier side, and liability, unearned income. And finally, paying for services in arrears that have not been invoiced. At the customer, we have a liability, accrued expenses, and at the supplier, an asset, accrued income. And we're going to go through each one of these. Explain how the following are accounted for. So first, a credit sale, how a credit sale is accounted for. So a sale on credit terms, at the time that the goods are delivered, inventory is marked down by the cost of goods sold. The seller takes the revenue from the sale through the income statement, and the amount invoiced, which will be the same to the customer, is recorded in the seller's accounts receivable. At the buyer's side, they record the amount that the goods cost as an increase in its inventory and the amount that is owed to the supplier in accounts payable. There's no impact on the income statement at the customer's end. And then finally, when payment is made, the balances in each account is reduced to 0 and marked as paid, no impact on the income statement. I'm explaining how the following are accounted for. I've got paying for goods, services in advance. So when the customer actually pays, the amount paid is reflected as a current asset under prepaid expenses or prepayments. At the supplier, when the cash is received, a matching entry is recorded under current liabilities as unearned or deferred income. There's no impact at this stage on the income statement at either firm. When the service or goods is actually delivered, the cost of the service is reversed from prepaid expenses at the customer and taken through the income statement as an expense. At the supplier, the same amount is reversed from its unearned income and taken through the income statement as revenue. And finally, explain how the following are accounted for: paying for services in arrears. So at the time the customer uses the service, the customer estimates the cost of the services it has consumed and takes this as an expense through the income statement. The amount owed is recorded in accrued expenses. The supplier can recognize this as revenue, provided it can estimate the cost of the service provided reliably, in which case the amount is recorded in accrued income. When the invoice is issued, the amount recorded by the supplier in accrued income is reversed and transferred to accounts receivable. The customer, the amount recorded as accrued expenses is reversed and transferred to accounts payable. It may be necessary to make minor adjustments at both firms for differences between estimates and actual values. Explain how cash and overdrafts can be viewed as complementary items. Most firms try to keep only as much cash as they need for liquidity purposes, for cash management. A company with a lot of cash has no need to borrow from banks. So if cash is high, the overdraft will be low or 0. If a firm has an overdraft, it usually does so because it has run out of cash. So if it has a high value for overdraft, cash will be low or 0. What two types of inventory is it possible to have, and how do they differ? Give examples of each. So the two types of inventory: identifiable and indistinguishable. Lots of different examples of each. Identifiable: washing machines, cars, batches of goods with use by dates, anything with a barcode on it that is actually tracked. Indistinguishable goods include oil, gas, steel, and other commodities where you cannot tell one part of the goods from another. What benefit does buying goods on credit give to a firm's customers? Well, the benefit that it gets is free credit, avoiding the need to either borrow from banks or finance the purchase from equity. What risk is associated with accounts receivable? Bad debt. This is the risk that customers take the goods or services but then either cannot pay for them or choose not to. And these are the questions which we looked at in this session.